Imagine a company that promised to redefine the electric vehicles, sleek design, futuristic tech, and a stock that skyrocketed over 1000% in a single year. That was NIO in 2021, dubbed the Tesla killer by investors and analysts alike. But fast forward to today, and its stock has crashed over 90%, leaving countless investors trapped in a financial nightmare. How did a company with so much promise become one of the biggest investor traps in recent history? So let's rewind back to 2014. A Chinese entrepreneur named William Li launches NIO with a bold vision: to build a premium electric vehicle that could rival Tesla, not just in China but globally. NIO wasn't just about cars, it was about a lifestyle. They offered battery swapping stations, subscription services, and even exclusive NIO houses. Think about luxury lounges for owners. By 2018, NIO went public, raising $1 billion despite not turning a profit. Investors didn't obviously care. The EV market was red hot and China was pumping billions into clean energy. And by 2020, NIO was delivering thousands of cars. Think models like ES6, EC6, which were sleek, tech-packed, and loved by Chinese consumers. Then came 2021. The stock exploded from $2 to a peak of 67, over a 3,000 gain from its low. Big institutions like Bailey Guilford and Blackford piled in, and retail investors on platforms like Reddit and Twitter were hyping it as the next Tesla. Social media posts scream NIO to 100 or 200. But here's the first red flag. NIO's valuation hit 100 billion, more than Ford or GM, while delivering just 43,000 cars that year compared to Tesla's 500,000. NIO's price to sales ratio was at a peak well over 20, even eclipsing the high valuation of Tesla back then in 2021. So the question is, was actually the hype maybe outpacing the reality? Well, spoiler, it actually was. Now let's talk about why the crack started showing. So first, NIO's business model was a money pit. Those battery swapping stations, super innovative. Drivers could swap a dead battery for a fresh one in few minutes, but building and maintaining thousands of these stations across China cost billions. In 2021 alone, NIO reported a net loss of 1.6 billion, even as revenue grew. Compare that to Tesla, which already was profitable by then. Secondly, also the competition was brutal. Tesla started to slash prices in China, eating into NIO's premium market. Then came BYD, Li Auto, then later Xiaomi. XPeng was hitting on strides, offering EVs at lower prices with similar tech. NIO cars were great, but they weren't unique enough to justify the premium tag. By 2022, NIO's growth slowed, deliveries were up, but not enough to match the hype. The stock started to slide, dropping to $20 and then 10. Investors who bought at the peak were already underwater, but many held on, thinking on that it might have been a dip, and that's actually when the trap started to tighten. By 2023, NIO was in a tough spot. To keep the lights on, it needed cash, lots of it. The company raised billions in 2022 and then another few billions in 2024 through new share offerings. Sounds fine, right? Except that each round diluted existing shareholders, meaning that their slice of the pie got smaller. If you own 1,000 shares at a $50, your stake was worth less with every new shares NIO issued. The stock kept sinking, hitting $3.50 by early 2025, few weeks ago. Roughly a 94% drop from its peak. So the question now is NIO doomed? Not necessarily, I wouldn't say. It's still delivering cars, over 200,000 last year in 2024. Its tech and autonomous driving and battery swaps still competitive. The company is also cutting costs, but the question is it fast enough or is it a little bit too late? And that is all according to the CEO William Li, which we know previously he's been very good at promising stuff, like aiming for the stars but not even reaching anything close. Remember that there's a catch, to be honest. Investors have heard these promises before. I mean, with billions in debt and ongoing net losses that are around $1 billion or so according to the latest quarter, and most likely looking to increase over the Q1 of 2025, the bigger question is whether NIO can escape its own trap. It's betting on premium EVs in a market that's shifting to affordability. Competitors like BYD are eating its lunch by offering like cars at much less cost that offer similarly same kind of tech. The question remains, is NIO doomed? Looking at some graphs, we can see also that the deliveries per year are still growing, but they're not. But they're also facing higher competition from Xpeng, from Li Auto, Tesla still there. We haven't talked about Zeekr or Link & Company. We haven't mentioned Xiaomi that detail. So there's a lot of competitors out there today compared to 2021. We've also seen NIO struggle usually in the early Q1 of each year. You can see that the bars, the greens being 2023, blue 2024, and the white are 2025 this year. They always struggle early in the year and they later try to ramp up. But the question is that, are they able to scale their business model? Looking at this other graph, we can see that despite their revenue increases, NIO is still struggling. On this graph, we can see that despite their revenue increases, their cost of sales goes up essentially as much over the past, 3-4 years. The gross profits goes up on average a little bit, but it's offset by their huge R&D and sales cost. They have a huge sales infrastructure. Their cars are expensive, so they need a lot of salespeople to sell their cars. Their SG&A budget compared to other competitors like Tesla and Xpeng are at least double per sold car. We can see the same with R&D. They're spending more on R&D per unit sold than Tesla or Xpeng or essentially anyone else. So no matter at what metrics you look at, especially the final important one, you can see on this graph there, net loss represented down there in the red. Currently at Q4 of 2024, they're not doing great. Their record ever largest net loss in the company's history. So things are quite dire right now for NIO, and it's hard to imagine that this CEO that has led so many investors in this very hard position, that you can even believe and trust in his words. On multiple occasions throughout this year, he has promised great things for NIO and the company and investors, and most of the time they go out there with great targets and vision, and the execution of those visions are very, very subpar, and usually they just utterly fall below their expectations. The latest of which was obviously the biggest talking point now from 2024, late Q4, where they mentioned that Onvo, the sub-brand, was supposed to do 16 to 15,000 sales in early 2023, and right now they're doing like 700 cars according to the latest weekly reports. We also know that NIO is losing a lot of money on their battery infrastructure, and the problem there is that they seem to not understand that the current capacity today, they have so much excessive capacity for these battery swap stations. The newest ones can handle roughly 480 swaps per day on a single swap station, whereas the utilization of those are roughly around 25 to 35. So they're not even capped at 10% of their capacity, and yet despite this, despite all this dire situation financially, they keep to throw this money and at these battery swap stations. So it's all points a picture to the leadership in this company is simply not good enough. And what do you people think? Do you think NIO is doomed? Is there a way for NIO to come back from this position, or is it simply too little too late? And is the competition too difficult right now? Is the battery charging, the very quick battery charging, we've seen like cars charging like 5, 10, 20 minutes very quickly and huge amount of the battery percent. So maybe the swap station advantage is like becoming less and less for every year. So what do you guys think? Is NIO doomed, or can they actually make a historic comeback? Thanks for your time. Please like, subscribe, and see you in the next one.